A year ago, when I talked about steel prices and spreads and raw material prices, I said that these were very much at the bottom and we expected to see a gradual improvement throughout the course of 2016. And indeed, pricing and spreads did evolve in 2016 in line with our expectations. It's important to first provide a little context and remind ourselves of the situation we faced at the start of 2016. If you recall, in the second half of 2015 and the start of 2016, steel spreads in China, being the difference between the steel sales price and the cost of raw materials used to make steel, had fallen to unsustainably low levels. The root cause of this was a crisis in the Chinese steel industry that led to very low prices and spreads, both on the domestic and export fronts. The Chinese steel industry was losing around $2 billion a month in the second half of 2015. Moreover, the low Chinese export prices were having a significant negative impact on prices and spreads outside China, including in our core markets. Fortunately, the dire situation in China led to some real changes and especially a clearer recognition by the government there of the need to restructure their steel industry and to begin to address the overcapacity issue. Along with other dynamics on demand and trade, this led us to believe that a correction would happen and that steel prices and spreads both within and outside China would recover. And this is precisely what happened in 2016, starting around February. If I want to summarize, there were 4 key factors that contributed to this recovery. Firstly, we have indeed seen progress in restructuring the Chinese steel industry and closing of capacity, although overcapacity remains and the Chinese government needs to be vigilant in delivering its restructuring plans and arguably go further than these. Secondly, Chinese steel demand, and it's worth remembering that China accounts for almost half of global steel consumption, held up better than many people expected. Key drivers being credit growth, a cyclical rebound in the real estate market, and a decision by the Chinese government to bring forward some key infrastructure spending. Thirdly, and very importantly, steel demand outside China improved through 2016 from the declines we saw in 2015. And finally, we saw trade tariffs imposed on steel products on both sides of the Atlantic in response to dumping from China and other countries. Now, the US was fast to move on this and has implemented tariffs on more or less all steel products. In Europe, this is not the case. And while we're pleased by the European Commission's response, we continue to call for comprehensive trade action, as what we have seen is imports into Europe switching to product categories on which tariffs are yet to be imposed. Looking back, it's also worth pointing out that, as we expected, 2016 also saw a recovery in raw material prices from the lows seen at the end of 2015 and beginning of 2016. Good demand and weaker supply supported iron ore price recovery, while Chinese policy to restructure another of its industries, coal, led to very strong prices for coking coal. Both of these are positive for ArcelorMittal given our exposure to the raw material markets. If I look forward to 2017 and the remainder of this year, these factors are continuing to provide support and steel spreads remain at healthy levels. In particular, growth in ex-China steel demand is accelerating, highlighted by strength seen in some key leading indicators that is starting to feed through into the hard data. As such, we're forecasting a positive steel demand environment for the year. In particular, growth is expected in both of our core European and US markets. Brazil, we believe, will return to positive growth, albeit from a very low base as the country gradually emerges from its recession. And we see a similar recovery picture in the CIS. So to summarize, 2016 evolved broadly in line with our expectations, and the outlook for 2017 remains healthy, and we're well placed to capture the benefits of this improved industry dynamic. That said, risks are always present in the steel industry, and we're cognizant of these and remain very focused on delivering our Action 2020 strategic plan, irrespective of market conditions.